Welcome to the deep dive. Hedge funds. You hear the name, and maybe you picture high-stakes finance, crazy fees, maybe strategies hidden behind layers of secrecy.
Yeah, it's got that mystique, doesn't it?
Totally. So for those of you who want to get past that and really understand what makes these players tick, well, you're in the right place. We're aiming for a rapid download on the core ideas here.
Exactly. For this deep dive, we've really gone deep into hedge fund secrets, an introduction to quantitative portfolio management. Now, it's by Philip J. Romero and Tucker Balch. And it's not exactly beach reading.
Right.
It's actually used to teach this stuff. But our goal today is to pull out those fundamental building blocks so you can really grasp the essence of hedge fund strategies, without needing a PhD in finance.
Our mission basically is to extract the core DNA of these strategies, give you a shortcut, sort of, to understanding how hedge funds actually try to make money. We want to strip away some of the jargon and focus on the underlying logic.
And just to set the stage, hedge funds operate with, well, less regulatory oversight compared to traditional investments like mutual funds. This gives them a lot more flexibility.
More room to maneuver.
Exactly.
Yeah.
They can be incredibly nimble, very creative in how they chase returns. Their main goal really is to exploit temporary mispricings in the market.
Mispricings. So like when something's selling for the wrong price.
Pretty much. Those moments when an asset's trading price, drifts away from what the fund believes it's true, underlying value actually is.
And this isn't a small corner of the market, is it?
Oh, not at all. The scale is huge. Just look at the growth between, say, 1997 and 2013. The money managed by hedge funds jumped 15 times, a factor of 15.
Wow.
Yeah, they now represent a very significant chunk of the liquid assets sloshing around in the U.S. financial system.
And the history books are full of big names, right? People who really shaped this industry.
Absolutely. You've got figures like George Soros, his quantum capital, famous for that massive bet against the British pound, basically breaking the Bank of England. That was a
Yeah.
huge macro play.
Right. I remember hearing about that.
Then there's Julian Robertson, founder of Tiger Fund. He was known for really deep fundamental research, and he mentored a whole generation of successful managers known as the Tiger Cubs.
Okay.
And you can't forget John Meriwether's long-term capital management, LTCM. Initially, everyone thought it was the pinnacle of quantitative finance, rocket science applied to markets.
But that didn't end well, did it?
No, it became a very stark lesson in the limits of even the most brilliant models.
Mm.
We could also mention Ray Dalio, Stephen Cohen.
Mm.
Each made their mark with different strategies, often posting really impressive returns for a time.
Okay, so let's try and unpack the basics. When we talk about investing in this whole context, what's the fundamental goal, and where do hedge funds really fit in?
Well, at its absolute core, any growing economy needs capital, right? It needs money put to work. So when people save, those savings need to be invested ideally in businesses or projects that promise good returns.
Makes sense.
The financial sector, broadly speaking, acts as the intermediary. It directs that capital towards opportunities with, hopefully, the best potential for growth and profit. Hedge funds are major players in this. They're constantly scanning the market, trying to allocate capital to what they see as undervalued or mispriced assets.
So finding those moments where the market price is out of sync with their view of the real value.
That's the key. Identifying and exploiting those temporary gaps between the market price and their assessment of intrinsic value.
So how do they actually do that? How do they find and profit from these mispricings? What are the main types of strategies they use?
The book lays out four main categories, broadly speaking. First, you have equity strategies. These focus on picking individual stocks. A really foundational approach here is the long-short model, pioneered by A.W. Jones way back.
Long short. Buying some, betting against others.
Exactly. Second is arbitrage. This is all about finding and profiting from unusual price relationships between different assets. You're betting that these relationships, which might have temporarily gone out of whack, will eventually snap back to normal. Started mostly with bonds, but now it's everywhere.
Okay.
Third, you've got momentum or directional strategies. Here, managers take a bigger picture view, looking at macroeconomic trends to predict the overall direction of market prices. Think currencies, commodities, interest rates.
Like those macro bets Soros made.
Precisely. And finally, event-driven strategies. These trades are based on specific corporate or market events, things like mergers, acquisitions, bankruptcies, maybe even major regulatory changes or global disruptions. The 90s saw a real rise in these global macro funds, often using event-driven tactics, and merger arbitrage became a big one too.
You mentioned long and short positions. Can you break those down a bit more and maybe explain this concept of leverage that always comes up with hedge funds?
Sure. Going long is simple. You buy an asset expecting its price to go up. You profit if it does.
Standard investing, basically.
Right. Going short is the opposite bet. You actually borrow an asset, usually shares of stock, and immediately sell it on the open market. The hope is the price will fall.
So you can buy it back cheaper.
Exactly. You buy it back at the lower price, return the borrowed shares to the lender, and the difference, minus fees and interest, is your profit. Hedge funds often use a hedged approach, meaning they hold both long and short positions simultaneously, though the balance between them can vary a lot.
Okay, and the leverage part.
Right, leverage.
Right.
Because the profit potential on any single trade, especially in arbitrage, might be quite small, maybe fractions of a percent. So to make those small edges meaningful, hedge funds often borrow significant amounts of money
To make bigger bets.
to make much bigger bets. This amplifies the potential returns. Of course, it also amplifies potential losses. In the UK, they often call this borrowing gearing.
Gearing, okay.
A common example you might hear is a 130-30 equity strategy. A fund might have, say, $100 million of its own capital. It borrows another $30 million.
Right.
It uses that extra $30 million plus its own $100 million to buy stocks it likes. So it's long $130 million worth of stock. Then it simultaneously shorts $30 million worth of stocks it doesn't like, or maybe just the broad market, as a hedge.
So the net exposure is still 100%, but they've magnified their specific stock picks, both long and short.
Precisely. It allows them to take bigger bets on their perceived skill in picking winners and losers, while potentially reducing their overall market risk.
It sounds like the way these strategies were developed and run has changed quite a bit over time.
Oh, massively. The early days, the pioneers like Jones, Robertson, Steinhardt, Soros, it was heavily based on the manager's gut feel, their deep experience, their intuition about specific markets or companies.
More art than science, maybe?
You could say that.
Yeah.
But then starting maybe in the 80s and really accelerating in the 90s, you had this rise of quantitative finance coming out of academia. Combine that with computers getting way more powerful and cheaper.
Suddenly you can crunch huge amounts of data.
Exactly. You could analyze massive data sets, look for subtle statistical patterns and relationships between asset prices that maybe weren't obvious to the human eye. This led to the rise of the quants.
The quantitative analysts, often physicists, mathematicians.
Yeah, people with strong math, physics, computer science backgrounds. They started developing automated trading strategies based purely on these statistical models. It was a big shift.
Okay, let's dig into arbitrage a bit more. You mentioned it earlier. The book seems to describe it in a couple of key ways. What's the fundamental idea?
At its absolute simplest, pure arbitrage is about exploiting a price difference for the exact same thing in two different places or forms simultaneously. The classic example is maybe the price of gold in London versus New York.
If it's cheaper in one place.
If for some reason gold is momentarily cheaper in New York than London, a pure arbitrager could instantly buy it in New York and sell it in London, locking in a virtually risk-free profit the difference, minus any transaction costs. It relies on temporary inefficiencies.
Like the oil example mentioned in the book, Brent versus West Texas Intermediate.
Exactly. Or you could even argue, maybe slightly stretching it, that a retailer is a kind of arbitrager buying goods wholesale and selling them retail at a higher price. They're exploiting a difference in value based on accessibility.
Okay, that makes sense for identical things. But the book also talks quite a bit about statistical arbitrage. How is that different from the pure risk-free version?
Right. Statistical arbitrage, or stat-arb, is a bit different and much more common for hedge funds today. It's not usually about identical assets. Instead, it looks for temporary deviations between an asset's market price and what a quantitative model suggests its fair or intrinsic value should be based on historical relationships or other factors.
So it's based on a model's prediction, not a guaranteed price difference.
Precisely. The arbitrage here is really a bet, a statistically informed bet, that the market price will eventually move back towards the model's predicted value.
So if the model says a stock is worth $50, but it's trading at $48.
The fund might go long, betting it will rise towards $50. If it's trading at $52, they might go short, betting it will fall.
And the key is these opportunities don't last long.
Generally not. In reasonably efficient markets, as soon as a mispricing appears, other traders using similar models will spot it and trade on it. Their collective action, buying the underpriced, selling the overpriced, pushes the price back towards equilibrium, effectively arbitraging away the inefficiency.
Like regression to the mean, things drifting back to average.
Exactly. That concept, regression to the mean, is a core principle behind many statistical arbitrage strategies. You're betting that prices that have moved unusually far from their historical average or relationship with other assets will tend to revert.
And so fundamental approaches like value investing or short selling, they can kind of be seen as forms of this broader statistical arbitrage idea.
That's a good way to think about it. Value investing, like Warren Buffett practices, is essentially taking a long position based on your analysis that a company is fundamentally undervalued by the market. A statistical deviation you expect to correct upwards over time.
And short selling is the flip side.
Right. Activist short sellers like, say, David Einhorn, identify companies they believe are significantly overvalued based on their fundamentals or maybe even accounting issues, and they take short positions, betting the price will eventually fall to reflect that reality.
But you said the margins on these trades are often small.
Very often, yes, especially in stat arb. The deviations might be tiny, and competition is fierce. That's why hedge funds pursuing these strategies typically need two things: significant leverage to amplify those small potential gains.
Right, the borrowing.
And high-frequency trading, HFT systems. They need incredible speed to identify and execute trades on these fleeting opportunities before they disappear.
Okay. The book then spends a good amount of time on value investing principles, drawing heavily on Benjamin Graham and Warren Buffett. What are the essential ideas from their philosophy?
Benjamin Graham is really considered the father of value investing. His core argument was that the stock market isn't always rational. Far from it. He believed that emotions, fear, greed, short-term speculation can push stock prices far away from a company's actual underlying or intrinsic value.
The famous quote, voting machine versus weighing machine.
Exactly. In the short run, the stock market is a voting machine, meaning prices are driven by popularity and sentiment. But in the long run, it is a weighing machine, meaning prices ultimately reflect the company's true economic worth, its fundamentals.
So find companies whose weight is more than their current vote.
That's the essence. Graham laid this all out in his hugely influential book, Securities Analysis and the Intelligent Investor. And of course, Warren Buffett was a student at Columbia, worked for him, and deeply absorbed these ideas, later building upon them significantly.
A key concept for Graham was the margin of safety, wasn't it?
Absolutely critical. Graham was very aware that analysis is never perfect. You can make mistakes, and bad things can happen unexpectedly. So he didn't just advocate buying a stock when it looked cheap. He advocated buying it only when it was trading at a significant discount to your estimate of its intrinsic value.
Like a buffer.
Exactly. That discount is your margin of safety. It protects you if your analysis was a bit optimistic or if the company hits a rough patch. Buffett often points to that chapter in The Intelligent Investor as maybe the most important concept for any investor.
And Buffett applied this early on.
Yeah, in his early Buffett partnership days, he was very much focused on finding these statistically cheap cigar butt companies, as Graham called them, maybe not great businesses, but selling for far less than their liquidation value. He generated amazing returns, often significantly beating the market, though he was sometimes willing to make bigger, more concentrated bets than Graham might have.
How did Charlie Munger change Buffett's thinking? His influence seems important.
Hugely important. Meeting Charlie Munger in the late 1950s really led to an evolution in Buffett's approach. Munger pushed him beyond just buying cheap businesses towards buying great businesses, even if they weren't at rock-bottom prices.
Quality over just cheapness.
Right. Focus on companies with durable competitive advantages, what Buffett later famously called economic moats. Things like strong brands, network effects, low-cost production. Munger's view was, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. That shift towards long-term ownership of high-quality businesses has been absolutely central to Berkshire Hathaway's incredible success.
Okay, so finding these undervalued companies is key. The book then gets into some basic methods for actually valuing a company. What are the main approaches discussed?
Well, at the end of the day, successful investing often comes down to having a better, more accurate view of what something is truly worth than the person selling it to you or buying it from you. Those differences in perceived value are where opportunities lie.
Even though markets are supposed to be efficient.
Yeah, even though markets generally incorporate information pretty quickly, inefficiencies do pop up. Value investors are looking for that margin of safety. Graham's idea of buying dollar bills for 50 cents. One basic way to start is asset-based valuation.
Looking at the balance sheet.
Exactly. You compare the company's book value, essentially, its assets minus its liabilities, maybe with some adjustments for realism, to its market capitalization, which is the total value of all its shares. The price-to-book ratio is a common metric here. Sometimes, especially with troubled companies, the market value might even fall below the stated book value.
But that's looking backward, right, at what the assets cost.
It is, and that's its limitation. It often doesn't fully capture a company's future potential. That's where the concept of intrinsic value based on future cash flows comes in.
Okay, tell me about that.
This approach recognizes the fundamental time value of money. A dollar today is worth more than a dollar promised next year because you could invest today's dollar and earn a return.
Right. Opportunity cost.
Exactly. So, to value an asset based on the cash it's expected to generate in the future, you have to discount those future cash flows back to their present value. The basic formula looks something like present value, PV, equals future value, FV, divided by 1 plus the discount rate, DR, raised to the power of the number of periods, FV1 plus DRI.
And the discount rate reflects the risk.
It reflects the riskiness of those future cash flows and the return you could get from alternative investments of similar risk. The higher the risk, or the better the alternatives, the higher the discount rate, and the lower the present value of those future cash flows.
So how does this apply to valuing stocks, especially ones that pay dividends?
Well, for a company that pays dividends, you can think of the stock's intrinsic value as the sum of the present values of all the future dividend payments you expect to receive from holding that stock.
All future dividends discounted back.
Theoretically, yes. Even if the dividend stays the same each year, the present value of a dividend received 10 years from now is much less than one received next year because of that discounting effect. The book gives an example. If a company pays a steady $1 dividend for 10 years and your discount rate is 8%, the total present value of those 10 payments isn't $10, it's about $6.71.
Okay.
It also introduces the idea of a perpetuity, a stream of payments that goes on forever. The present value is simpler, just the annual payment, D, divided by the discount rate, DR. So a hypothetical DivCo paying $1 forever with an 8% discount rate would be valued at $1.10 each sold for every 8%. Interestingly, even in that forever example, more than half the value comes from the first 10 years of dividends.
What about companies that don't pay dividends or ones expected to grow really fast? You can't just use current dividends then.
Right. For growth companies, or those reinvesting all their profits, you use growth-based valuation methods. These usually involve forecasting the company's future earnings, or, more commonly, its free cash flow, the cash left over after all expenses and investments.
And then discount those future cash flows.
Exactly. You project those cash flows out for a number of years, maybe estimate a terminal value for the business beyond that projection period, and then discount everything back to the present. The tricky part here is that these valuations are highly sensitive to your assumptions about future growth rates, which are inherently uncertain.
So you might get different answers depending on the method, asset-based versus cash flow.
Definitely. Asset-based valuations often give a lower, more conservative estimate because they're based on historical costs. Cash flow valuations look at future potential, so they can be higher, but they depend more on those uncertain forecasts. Analysts often use a range of methods and consider different scenarios. Graham, the value investing purist, really emphasized sticking to the conservative end and demanding that margin of safety.
So don't overpay for optimistic growth projections.
That's the idea. The authors of this book kind of summarize it nicely. Aim to be roughly right in your valuation and only buy when you see a significant discount. Maybe only pull the trigger if you think you're buying dollars for, say, 80 cents or less.
Okay, that makes sense. The discussion then shifts towards market efficiency and something called event studies. What's the core idea behind the efficient market hypothesis, the EMH?
The EMH is a really big theory in finance. Basically, it suggests that asset markets like the stock market are generally very good, very efficient at reflecting all available information and prices.
Meaning prices are usually right.
In a sense, yes. The idea is that as new information comes out, investors react quickly and rationally, incorporating that news into the price. This makes it really hard to consistently beat the market just by trading on publicly available information because it should already be baked into the price.
So finding those mispricings hedge funds look for should be difficult if markets are truly efficient.
Exactly. The more efficient the market, the fewer and more fleeting those opportunities become. A lot of financial regulation, like rules about corporate disclosure or insider trading, is actually aimed at promoting market efficiency by making sure information gets out there broadly and fairly.
And there are different degrees or forms of this efficiency.
Yes. Eugene Fama, who did a lot of the foundational work, described 3 forms. The weak form says current prices reflect all past market data, old prices, trading volume, etc. So technical analysis, looking for patterns in charts, shouldn't consistently work.
Okay.
The semi-strong form goes further. It says prices reflect all publicly available information, earnings reports, news, economic data, analyst opinions. If this holds, then fundamental analysis based on public info shouldn't consistently generate abnormal returns either.
And the strong forms.
The strong form is the strictest. It claims prices reflect all information, public and private, or insider information. If this were true, even insiders couldn't consistently profit from their special knowledge. Most people agree the market probably isn't strong form efficient, hence insider trading laws. The semi-strong form is maybe the most debated and relevant for most investors.
So in an efficient market, how does news actually affect prices? Only surprises matter.
That's the key implication. Only unexpected news should really move prices significantly. If everyone expects a company to announce great earnings, and they do, the price might not budge much because that expectation was already factored in. It's the surprises, positive or negative, that cause the adjustments.
And event studies look at these reactions.
Right. Event studies are a research tool used to analyze how stock prices behave around specific events, earnings announcements, merger news, drug trial results, whatever. The book mentions a study by McKinley that looked at price movements over 21 days around good and bad news.
What did it find?
Interestingly, it found typical patterns. Bad news usually led to a price drop, maybe followed by a partial recovery. Good news led to a price jump, sometimes followed by a bit of a pullback or retracement. What was also interesting is they often found slight price drifts before the official news release, suggesting the market sometimes anticipates events, maybe through information leakage or just smart analysis.
And these events can be company-specific or bigger picture.
Both. You have company news, industry news, and then broad economy-wide events. Those macro hedge funds we mentioned specialize in figuring out the ripple effects of these bigger events, like a slowdown in the U.S. economy might hurt manufacturers in China, or a drought in Brazil might boost tea prices if coffee becomes more expensive.
So it's about connecting the dots across different markets.
Yes. And the book makes a good point here, too. Even with sophisticated, automated trading systems reacting to news instantly, there's still a crucial role for human oversight. You need that sanity check to make sure the algorithms aren't going haywire based on faulty data or an unforeseen interpretation.
Okay, let's move to the capital asset pricing model, CAPM, and these ideas of beta and hedging. These seem like fundamental tools for thinking about risk and return.
They really are. CAPM gives us a framework for understanding the relationship between an investment's risk specifically, the risk you can't diversify away, the market risk, and its expected return. It helps separate the returns you get just for being in the market versus returns specific to that investment.
How does it do that?
It looks at how sensitive an asset's price is to overall market movements. The book shows a chart comparing ExxonMobil, XOM stock, to the S&P 500 index, SPX, showing they tend to move together, positive correlation. CAPM formalizes this by breaking down a stock's expected return into two main components, beta and alpha.
Beta and alpha. Heard those terms a lot.
Right. Beta measures how volatile a stock is relative to the overall market. A beta of 1 means the stock tends to move in line with the market. Beta greater than 1 means it's more volatile. Less than 1, less volatile. Alpha is the extra bit. It's the return the stock generates above or below what its beta would predict, given the market's return. It's often seen as a measure of manager skill or unique company factors.
So the formula is something like return, beta market return plus alpha.
Basically, yes. Expected return stock I, expected return market plus alpha I. If you want to outperform the market, you can either take on more market risk by buying high beta stocks, or you can try to find investments with positive alpha. That's the real goal of active management.
And how does hedging fit into the CAPM picture using beta?
Hedging, in this context, is about managing or neutralizing that unwanted market risk, the beta risk. If you think a specific stock, like XOM in the example, is going to outperform, generate positive alpha, but you're worried the whole market might go down.
You could lose money even if your stock does relatively well.
Exactly. So you could hedge, you'd go long XOM, but simultaneously go short a broad market index ETF, like SPY, which tracks the S&P 500. By shorting the market, you're trying to cancel out the impact of general market movements.
So your profit or loss depends more purely on whether XOM actually outperforms the index, on its alpha.
That's the aim. The book shows a simple portfolio, 50% long XOM, 50% short SPY, to illustrate how it reduces market exposure. Many hedge funds try to build beta-balanced or beta-neutral portfolios. They carefully select longs and shorts so the overall weighted average beta of the portfolio is close to zero.
Trying to isolate alpha.
Trying to isolate alpha and make money regardless of whether the overall market goes up or down. But as we discussed, these alphas, these excess returns, are often quite small.
Which brings us back to leverage again.
Right. To make those small alphas generate significant returns on capital, funds often need to trade in large volumes and use substantial leverage, magnifying the outcome.
Okay, the last core concept before we get into practical stuff is this fundamental law of active portfolio management. Sounds important.
It is a really insightful framework developed by Richard Grinold. It connects a manager's performance potential to two key things: their skill and their breadth.
Skill and breadth, what do those mean here?
Skill is basically how good the manager is at forecasting future returns, picking winners, avoiding losers. Breadth refers to the number of independent investment decisions or bets the manager makes over a period, say, a year.
And the law connects these.
Yes. A simplified version says that your potential performance, often measured by something called the information ratio, which we'll get to, is equal to your skill multiplied by the square root of your breadth. Performance, skill, X breadth.
Square root of breadth. That's interesting. So adding more bets helps, but with diminishing returns.
Exactly. To double your performance potential at the same skill level, you don't just need twice as many bets. You need 4 times as many independent bets because of that square root.
How does this help explain different hedge fund styles, like comparing Buffett to a big quant fund like Rentec?
It's a great way to understand the contrast. Warren Buffett is the classic example of extremely high skill, focused on a relatively small number of investments, low breadth. His deep understanding allows for very accurate long-term predictions on those few bets. The law suggests that for someone with his level of skill, drastically increasing breadth might not even help much, maybe even hurt if it dilutes his focus.
Right, his circle of competence.
Exactly. Then you have a firm like Renaissance Technologies. They use complex algorithms to make vast numbers of trades across thousands of securities every day. Their breadth is enormous.
But maybe the predictive skill on any single trade isn't as profound as Buffett's.
Probably not as deep on any one specific company, no. Their edge might be statistically smaller on each individual prediction, lower skill per bet. But because they make so many independent bets, that massive breadth, even under the square root, allows them to generate very high, consistent overall returns. It's a different path to success.
The book also mentions the information ratio, IR, and information coefficient. I see. How do they fit in?
Right. The information ratio, IR, is a standard way to measure risk-adjusted return for active managers. It's basically the portfolio's average excess return, alpha, divided by the volatility standard deviation of those excess returns. Higher IR is better, more consistent outperformance.
Okay.
The information coefficient, IC, is a direct measure of that skill component we talked about. It's the statistical correlation between the manager's forecasts and the actual outcomes. A perfect forecaster would have an IC of 1.
So how does the fundamental law look with IR and IC?
The more formal version of the law is IR equals ICE's breadth. Information ratio equals information coefficient times the square root of breadth.
Ah, okay. So it shows skill, IC, has a direct linear impact on risk-adjusted return, IR, while breadth has that square root diminishing impact.
Exactly. It really highlights the value of genuine forecasting skill, IC. It supports why someone like Buffett, with presumably a very high IC within his circle of competence, can do so well even with lower breadth. But there's often a trade-off. If you try to increase breadth too much, maybe you step outside your expertise and your IC might start to fall.
Finding that right balance between skill and the number of opportunities.
That's the challenge for active managers.
Okay, moving into part 2 of the book, it gets more practical, starting with the actual mechanics of how markets work market making. How do trades physically or electronically happen?
Right. Markets are just places, physical like the New York Stock Exchange floor, historically, or virtual like NASDAQ, where buyers and sellers meet. But you and I, as investors, don't usually trade directly with each other.
We use brokers.
We use brokerage firms. They act as intermediaries. The brokers then interact with market makers. On the NYSE, these were traditionally the specialists assigned to specific stocks. On electronic markets like NASDAQ, multiple competing electronic market makers provide liquidity by constantly posting prices at which they're willing to buy the bid and sell the ask.
And when we place an order, there are different types.
Yes. The two most basic are market orders and limit orders. A market order just says, buy me X shares at the best currently available price. It prioritizes getting the trade done quickly.
Might not be the exact price you saw a second ago.
Could be slightly different, especially in fast markets. A limit order is more specific. You say, buy me X shares only if the price is dollars or lower, or sell my shares only if the price is zillitor or higher. It gives you price control, but your order might not get executed if the market doesn't reach your price.
And all these waiting limit orders create the order book.
Exactly. The order book is that electronic list showing all the buy and sell limit orders waiting at different price levels. Seeing the depth of orders on each side gives traders clues about supply and demand and potentially where the price might move in the very short term.
The book then talks about the advantage of milliseconds and this controversial idea of front-running. This sounds like high-frequency trading territory.
It definitely is. It turns out that not all trades go straight to the public exchange. Your broker might get a buy order from you and a sell order from another client for the same stock, and they can match those internally. That's called internalization.
Faster, maybe cheaper for them.
Yes. Big institutions also trade directly with each other in private venues called dark pools, partly to execute large trades without immediately signaling their intentions to the public market. Market makers also net out buys and sells internally.
So a lot happens away from the main screen price.
A surprising amount. And those tiny imbalances in the order flow, even within a broker's own system or a dark pool, can predict price movements milliseconds ahead of the public quote. This created a huge arms race for speed.
Fiber optics, putting servers right next to the exchange. Co-location.
Exactly. Collocation, shaving microseconds off trading times. Because if you can see that imbalance in trade just before the price moves, even if it's a tiny move, you can make money consistently, especially with volume and leverage.
And front-running fits in here how?
Well, front-running, in its illegal sense, is when a broker trades for their own account ahead of a large client order they know is coming, specifically to profit from the price impact of that client's trade. That's prohibited.
But there's a gray area.
There's a broader sense where HFT firms use their speed advantage to detect buying or selling pressure in the order book and trade ahead of the slower market participants reacting to that pressure. It's exploiting that millisecond information advantage. Whether that's beneficial market making or predatory trading is a huge debate, but it's central to many HFT hedge fund strategies.
Okay, let's talk data. The book stresses that just using raw stock prices for analysis can be really misleading. Why is that?
Yeah, this is a crucial practical point. If you just download historical stock prices and run analysis, you can get completely wrong results because of things like stock splits and dividends. These events change the share price, but not necessarily the underlying value of your investment in the same way.
So you need adjusted prices.
You absolutely need adjusted price data for any serious historical analysis or strategy backtesting. Adjusted prices account for these non-economic changes to give you a true picture of historical performance.
Let's break those down. First, stock splits. What happens there?
A stock split is when a company increases its number of shares outstanding. Like a 2-for-1 split means if you owned one share at $100, now you own 2 shares, but each is priced at $50.
So your total value is the same, $100.
Exactly. The company's total market value doesn't change. They often do it to make the share price seem more affordable. But if you just plot the raw price, it looks like the stock suddenly crashed by 50%.
Which it didn't.
Right. Adjusted data fixes this by mathematically working the split backwards through history, so the historical chart reflects the equivalent pre-split prices, showing a smooth continuum of performance. The book's IBM example shows a massive difference over decades between adjusted and unadjusted price history. Some companies, like Berkshire Hathaway Class A, famously don't split, leading to very high per-share prices. And you can have reverse splits, too, the opposite process.
What about other data problems like breaks in series or missing data?
Yeah, that happens too. A stock might stop trading for a few hours or days. Maybe a technical glitch at the exchange, maybe regulatory halt. Your data feed will just have a gap.
And software doesn't like gaps.
Nope. Most analysis tools need continuous data, so you have to fill those gaps. The standard approach is fill forward. Replace the missing price with the last known good price.
Just assume the price didn't change?
Basically, yes. If the gap is at the very beginning of your data, you might have to fill backward using the first available price. The rule of thumb is usually fill forward first, then fill backward if needed for the start.
And the last data issue mentioned is missing ticker symbols.
Right. This happens because companies aren't static. They get listed via IPOs, they get delisted through mergers, buyouts, bankruptcy. Sometimes they just change their ticker symbol. Sun Microsystems, the book notes, traded under several different tickers over its life.
So if you're testing a strategy over 20 years,
You need to make sure your data source correctly handles these changes, mapping the old tickers to the new ones, and includes companies that existed back then but don't anymore. That's avoiding survivor bias. Otherwise, your backtest results could be completely meaningless.
Okay. The book briefly lists some data sources. What are the key things you'd look for in a good data feed for serious trading?
You want comprehensive historical depth and current data. Crucially, it must be free of that survivor bias, including the dead stocks is important. It needs to be easy to integrate with your analysis software. And for many strategies, especially shorter-term ones, low latency, getting data almost instantly is vital. Some providers mentioned are Thomson Reuters, Starmine, Insider Insights, Zignite.
And they offer more than just price, like news or sentiment.
Yeah, some offer specialized feeds. Thomson Reuters has machine-readable news, sometimes tagged with sentiment, positive, negative. Starmine aggregates analyst estimates, weighting them by past accuracy, trying to predict earnings surprises or sentiment shifts. Insider Insights tracks buying and selling by corporate insiders, executives, directors.
Is insider buying usually seen as a good sign?
Generally, yes. Insiders might sell for many reasons, diversification, needing cash, but they usually only buy if they think the stock is undervalued. The book shows an example study using that data, looking at price trends after insider buys versus sells.
Okay, the last major section is the detailed case study of long-term capital management, LTCM. This is a famous story in finance, isn't it?
Oh, absolutely. It's the quintessential hedge fund cautionary tale. Huge success, then spectacular failure between about 1993 and 2000. It shows both the allure and the potential dangers of highly complex leverage strategies. The book references classic accounts like Lowenstein's when genius failed.
What was the origin? Who was behind LTCM?
It was founded by John Merriweather, who previously ran a legendary, highly profitable quantitative arbitrage group at Salomon Brothers. The bond trading desk famously featured in Michael Lewis's Liar's Poker. He assembled this absolute dream team.
Including Nobel Prize winners?
Yes, Robert Merton and Myron Scholes, who won the Nobel, partly for their work on the Black-Scholes option pricing model, a cornerstone of modern finance. Plus, David Mullins, a former vice chair of the Federal Reserve. Just an incredible amount of brain power and pedigree. They launched with a massive $2.5 billion in capital, unheard of at the time.
And they were successful initially, extremely successful.
Phenomenally successful for the first few years. Their reputation gave them amazing advantages. They got the best trade pricing, the lowest borrowing rates from banks, and they used massive leverage. Reportedly something like $30 borrowed for every $1 of their own equity.
Wow, 30-to-1 leverage.
Yeah, incredibly high. And the partners genuinely believed their complex models made their bets very low risk, almost like a bank's portfolio. Despite the leverage, they were supremely confident.
But then it all went wrong. What happened? What triggered the collapse?
Their main strategy was fixed income arbitrage. They made bets that the spreads, the price differences between various types of bonds, would eventually converge back to their historical averages. They were betting on rationality returning to the market.
And it didn't.
Not when they needed it to. In August 1998, Russia defaulted on its debt. This triggered a massive global panic, a flight to quality. Investors dumped riskier bonds and piled into safer ones, like U.S. Treasuries. This caused the very spreads LTCM was betting on to converge to instead widen dramatically, blowing huge holes in their portfolio.
And because of the leverage.
Because of the leverage, these widening spreads caused catastrophic losses very quickly. They faced margin calls, demands from lenders for more collateral. They didn't have the liquid cash, forcing them to sell assets into a falling, panicked market, making losses even worse. It's the classic John Maynard Keynes quote, "The market can remain irrational longer than you can remain solvent."
And this wasn't just LTCM's problem, was it? It threatened the whole system.
That was the huge fear. LTCM was so big and so interconnected with major global banks who were both investors and trading counterparties that its failure could have caused a domino effect, a systemic financial crisis.
So the government stepped in, or the Fed.
The Federal Reserve Bank of New York stepped in, not with public money, but by organizing a bailout. They basically locked the heads of the major Wall Street banks in a room and pressured them to collectively put up $3.6 billion in new capital as a bridge loan.
To unwind LTCM's positions in an orderly way.
Exactly, to prevent a fire sale that could crash the whole system. Time magazine famously called the group involved the Committee to Save the World. Even with bailout, LTCM continued to lose money across almost all its diverse strategies for another 18 months as positions were unwound.
What was the final outcome? What were the lessons?
LTCM was essentially liquidated by early 2000. Merriweather started another fund later. The genius partners lost most of their personal fortunes. Ironically, many of the initial investors had actually taken money out in 1997 when the fund was doing well, so they were somewhat protected.
Lucky timing for them.
Very lucky. The big lessons were stark reminders about the dangers of extreme leverage, the fact that even the smartest modders can fail in unforeseen tail risk events, and how interconnected the financial system really is. You could argue the LTCM experience, painful as it was, maybe helped regulators and banks be slightly better prepared for the even bigger crisis in 2008.
Okay, the final part of the book looks at the broader hedge fund industry today, the challenges, the opportunities. It seems like the landscape has really shifted.
It really has. Hedge funds went from being this sort of niche, secretive thing for the super rich to a mainstream asset class. Trillions under management now, almost as many hedge funds as mutual funds.
But performance hasn't always kept up.
That's been a major challenge. Average hedge fund performance, measured by broad indices like the HFRI, often lagged the simple S&P 500 index, especially in the years before and after the 2008 crisis. It even trailed a basic 60-40 stock-bond portfolio over the 2020-14 period mentioned.
Which makes it harder to justify those high fees, the 2 and 20.
Exactly. That standard 2% annual management fee plus 20% of profits is under pressure when average returns aren't stellar. This might be leading to investors pulling money out quicker, maybe shorter fund lifespans, and a bigger gap opening up between the few star funds that can still command high fees and everyone else.
What about regulation and marketing? Have things changed there?
Historically, they couldn't advertise publicly at all. They mostly got money from institutions or through funds of funds. Regulations like Dodd-Frank after 2008 and the JOBS Acts more recently has slightly eased restrictions, especially for marketing to accredited investors. And you're seeing more alternative mutual funds trying to mimic hedge fund strategies for retail investors.
And more scrutiny from regulators.
Definitely more scrutiny, especially on things like insider trading. The SAC Capital case, with indictments and the firm converting to a family office, was a big signal. Just the taint of suspicion can be fatal now. Dodd-Frank was seen by some as limited reform, though, and there's ongoing debate about needing more rules around leverage or derivatives.
And the front-running issue with HFT, still a concern.
Still a huge debate. That speed advantage from co-location and fast data feeds is real. HFT now dominates daily trading volume. Proponents say it provides liquidity and tightens spreads, making markets more efficient. Critics say it adds volatility, think flash crashes, and creates an unfair two-tiered market. Getting effective regulation is tough because trading is global and technology moves so fast.
What about those dark pools and private exchanges?
They're basically an extension of brokers internalizing trades. Big firms trading directly with each other, off the public exchanges, often to save fees or hide large orders. They're less transparent, and regulators are definitely trying to get more oversight, but again, innovation tends to stay ahead of regulation.
So what's the book's final take on where hedge funds are headed?
The conclusion seems to be that the underlying drive to innovate in finance, and often to operate just outside the heaviest regulations, isn't going away. Hedge funds had a kind of golden era, maybe, but competition is intense now, and those easy profits, the low-hanging fruit, might be gone.
So more pressure on fees, maybe more like mutual funds over time?
Potentially. The average fund might struggle to deliver truly outstanding alpha consistently. Pricing might become more competitive, more like traditional asset management. But the authors also expect new, innovative funds will always emerge. And perhaps the lines will continue to blur between hedge funds and other investment vehicles, which could maybe ultimately be good for regular investors seeking access to different strategies.
Okay, so wrapping up our deep dive today, we've really journeyed through the core ideas behind hedge funds. We started with those fundamental value principles from Graham and Buffett.
Right, the margin of safety, understanding intrinsic value.
And moved through arbitrage, market efficiency, quantitative models like CAPM, beta, alpha.
All the way to the practicalities of trading, data issues, and the big lessons from LTCM. It really highlights how vital it is to understand risk, return, and how markets actually work, or sometimes how they don't work rationally.
And hopefully peeling back some layers on these strategies has given you a much clearer picture, a kind of foundational toolkit for understanding this complex, often opaque corner of the financial world.
Yeah, the goal was to demystify it a bit, pull out those core building blocks so you can make more sense of it all.
So here's a final thought for you to take away. How might some of these core principles, like thinking about a margin of safety, or considering whether the market is truly pricing something efficiently, or understanding the difference between market risk, beta, and specific skill, alpha, How might those ideas apply to your own investment thinking, even if you're not running a multi-billion-dollar hedge fund?
It's worth considering. Maybe dig deeper into CAPM, or read up on the efficient market hypothesis, or revisit that fascinating LTCM story. There are valuable lessons there for any investor.
Absolutely. Well, thank you for joining us for this deep dive.